Hello, I'm Paul Black, and this is Kurt Winrich. We are co-CEOs of WCM Investment Management.
We are, as you probably know, a global growth equities manager that uses a focused or concentrated portfolio. And most of the time when people hear that, they immediately conclude this has got to be pretty risky. We'd like to get that off the table right away.
It's really important for you to know that everything that we do in this portfolio has to do with making sure we participate on a much lesser degree when markets go down.
Most managers that we've run into will tell you that our process involves finding a high quality business with a very wide moat, the old competitive advantage metaphor from Buffett, high quality, wide moat, discount to intrinsic value.
Didn't that rock your world, right? Have you ever heard that before? Have you ever heard a manager come in and say, hey, we buy high quality, right? Nobody ever admits to buying junk.
That's right.
We buy competitively strong businesses. No one ever says they're going to buy competitively disadvantaged businesses. And you know what? We want to buy them cheap. Well, really? You don't want to pay too much for them? Our argument is the fact that everybody's looking at the market the same way should cause you to step back and be concerned. Because the reality is, if that's what everybody's doing, the probabilities of finding inefficiencies in the market are very, very small. So we do things very differently around competitive advantages. We do things very differently as well around culture.
There are lots of great companies today that are building and digging very, very big moats, but the market hasn't realized it. And so, we realized over time that the greatest source of value creation in the portfolios was coming from, not buying these businesses with big moats, but ones that were growing significantly in the future, particularly because the market tends to sort of underestimate those companies. They underestimate the growth and profitability of those types of businesses over time. And then the last real reason that I think moat trajectory or buying businesses with wide moats is really, really important is that you don't want to overstay your welcome in businesses that are no longer getting better. So it's really, really difficult to know when to sell companies. It's probably the single hardest part about investing. You run a concentrated portfolio of high quality companies. Your ability to make that distinction between when that good business is no longer a good investment is really, really difficult to do. And so by saying, hey, we're only going to own companies that we're convinced are continuing to get better, sort of as another way to ensure that we're not going to own businesses that actually don't just have wide moats, but maybe just moats that are actually shrinking as well.
So really focusing on the direction of the competitive advantage as opposed to the size of the competitive advantage, that's what we call moat trajectory, and we find it to be the most correlated factor to stock returns over the long run.
We completely reframe the question, right? It's not, hey, is this a great company with a wide moat? It's, can we make the case over the next 10 or 15 or 20 years that the moat or the competitive advantage is actually getting stronger? And if we can't, then we have no business owning that company, because no matter what valuation work you do on it, it's going to show it to be far too expensive if that moat's deteriorating.
What gives us confidence that a company we identify that's growing its advantage can keep that growing for a long time? We think that comes down to one big idea, and we call it culture. It's the way the people are treated that allows them to do their best. And when they do their best, they help to innovate, they help to grow edges. That's what keeps a company ahead of its competition, by having great people and letting them do great things.
There's really three things in a great corporate culture. First and foremost, we want to find culture and strategy alignment. So you sit down with the company, you try to understand what its goals are, what the strategy is, what the competitive advantage is, and then you make sure that there are values and behaviors in the organization that are rewarded, that are going to help that company go execute that strategy. The second piece is adaptability. So cultures are like moats. They're either getting stronger or weaker. They're either getting healthier or they're dying. And you want to find companies that are trying to get better over time. And so we talk a lot about what are your big mistakes? What are some of the best lessons learned? You want to find companies, adaptable companies are ones that really study their competition and their market. They're not just going to give you some answer about just studying what's going on inside in the walls of their own business. But when you ask them a question about competition, you get real insight. In fact, you get them to admit that they're actually trying to steal some of the good ideas from their competitors to become bigger, to become better over time. And then thirdly is strength. And strengths, it's simple. It's just asking as many people as you can the same questions over and over and over and over again about their culture. And if you hear the same answers, the same anecdotes, the same passion, then you know that that culture is also very, very strong. So all three of those things together is really what separates, we think, sort of the good companies that you want to own for the next 5 years, so the ones really that are going to be in your portfolio for the next 15 or 20.
Another advantage of being a global growth manager, we think, comes down to a structural advantage. When you think about what growth managers naturally buy, they buy companies with high returns on invested capital, little or no debt, lots of free cash flow. Usually the companies that we buy have some kind of franchise or brand. And typically when you're investing in global growth businesses, you are pretty heavy in consumer names, healthcare names, and tech names. Now, why is that an advantage? From our perspective, it's an advantage because it gives people, clients primarily, exposure to industries that they're not really represented well in. Because remember, when you look at the global benchmarks, most of those benchmarks represent the underlying companies that are in their particular countries, and therefore they're very heavy in financial stocks, a lot of European banks, very heavy in industrials, material companies, energy, and other commodity businesses.
Disposable incomes are on the rise. Certainly not without fits and starts. You're going to have recessions, you're going to have this, but the general trend is upward. And think about, what is the developing world going to do when they have higher incomes? They're going to do what we do in the developed world. They're going to demand better consumer goods, higher quality. They're going to demand better health care. You see it all over the world. China, India, Indonesia, they're all spending more in health care. They're going to demand technology. In fact, technology is what frees them to grow their incomes. Those are the places in the world that are growing. If you have a portfolio full of these businesses that are actually capturing the trends around the world, where the growth is, how it's developing, your portfolio has a natural tailwind behind it that gives you an advantage because the world is moving to where your portfolio is.
This portfolio fits perfectly with any value manager out there that's heavy in those industries that we're not in. So as a complement, people are way under allocated to the growth sectors around the globe. We give them that exposure in a very effective way.
Portfolio construction plays a role, and it's important. Now, we do, of course, all the standard things, right? You want to diversify by sector, you want to diversify by industry, 15 different industries, limits on sector sizes. You got to make sure you've got different currencies, you've got different regions. We think about it even farther along than that. We talk about different types of tailwinds. We don't want every name dependent on one kind of global trend. We want to be different there. We pay attention to what kinds of competitive advantages they have. Most people say things like, well, how much in emerging markets do you have? And they ask that question based on where the headquarters of a company is. In this modern world, the location of your headquarters is almost irrelevant. So what we pay attention to is how's the revenue distributed around the world. We want to think that way as well.
And so when we look at a prospective investment idea, after it's cleared all the hurdles around Moat trajectory and culture and quality, the last question we really ask is, how is this going to change the overall complexion of the portfolio? So does it have a more defensive growth characteristic? Does it have more cyclical growth characteristics? And we think the balance of all those different elements and really understanding the role that the company is going to play in the portfolio has been a really big reason that our results have been so consistent over time.
That's why our portfolio protects on the downside. That's why it participates well on the upside. That's how we've built the long track record.
We love what we do. That's why we show up every single day. And we look forward to doing that for a long time into the future, don't we?
Yeah, we do.
Thank you.
Thank you.